Welcome to My Financial Coach Live.
Good afternoon. Is this Peter?
Hello, this is Pete.
Good afternoon, Pete. This is Empo calling on behalf of My Financial Coach for our My Financial Coach Live webcast. How are you doing this afternoon?
I'm doing very well. How are you?
Excellent. So on our program, we like to reach out to some of our subject matter experts who have proficiency in a lot of different areas. And so for the benefit of our listeners at home, could you give a little bit of background about yourself and your firm?
Yeah, I started in this business in 1971, so you might say I've been in the business 50 years if you do the math. So I started in the life insurance business at first, and then I've always been in the life insurance business, but then in 1974 I started my pension consulting company called CBC Retirement Partners, where we design and implement all forms of retirement plans for businesses of various sizes. But we've really been emphasizing in recent years very large tax deductions for business owners who have the capacity to need deductions for themselves and key employees in the $500 to $1 million range each. But we've also get involved in some other areas. One of the big things these days is we hear all of the stuff going on at congressional level, and our new administration is they want to increase taxes for those earning over $400,000 a year. So if that's true and it actually comes to fruition, then many clients who are putting money into into qualified plans are going to be paying a higher tax when they take it out as opposed to when they put the money in.
Well, Pete, I'm glad that you're able to give some background about yourself and your firm. It actually brings us to today's topic for our conversation. With recent tax proposals anticipated to increase taxes on high-income earners both now and in the future, how are highly compensated individuals able to shelter their income in a meaningful way while preventing taxes potentially today and into the future?
There's a number of ways that we've developed a number of tax strategies. If I look, for example, in one area, the qualified plan arena, where most advisors, they go in and they say, hey, you need a 401k or you need maybe even a defined benefit plan, but they'll implement perhaps a cash balance plan, which for the age 52-year-old maxes out a contribution of about $270,000. Most financial advisors don't know that with another design, with documents approved by the Internal Revenue Service, you can actually take that tax deduction upwards of $500,000 a year. But most financial advisors don't know I've been in business so long, I know sections of the code, and our actuary knows sections of the codes that have been on the books for 20, 30 years, and most financial advisors don't know that those code sections are still available. So that's one way is the qualified plan arena. And then, we've also set up a number of captive insurance companies for our clients because what happens in the qualified plan arena, if a client's got a really nice tax deduction going on in the qualified plan, that will begin to drop off in terms of the amount of money they can put in later years. And so we have captive insurance companies for those that qualify to continue to increase that tax deduction as their income increases into their 50s and 60s, ages 50s and 60s.
Yeah, so Peter, it sounds as if you shared a lot of information with our listeners at home. It sounds as if one area is in defined benefits, or as many people know them colloquially as pension plans. And then the second idea is the captive insurance agency. Could you tell us a little bit more about how pension plans have been stigmatized over the years and why people shy away from them versus why they actually may be a good idea and who it may be a good idea for?
Yeah, that's an excellent question, and I'll try not to get too deep in the weeds and confuse people, but basically the stigma is primarily around if you have to include your employees. If I have X dollars to put into a retirement plan as a business owner, if I don't put money in a retirement plan, I have to pay, let's say, 40 or 50% tax on that. Let's make up a number. Let's say it's $100,000, even though the deductions are larger than that. Well, if the business owner takes that as profit out of their company and they've got to pay 40% tax, they end up with 60%. And the stigma that many pension plans have was if you got to include employees, you're still going to give that kind of money away. So why, or even more if you have to pay for employees. So that's one of the bigger problems is the money you have to fund for employees because, as you know, qualified plans cannot be discriminatory and provide benefits solely for the business owner. but there's tools and techniques that we can use in the discrimination rules to make sure that employers get 70 to 92%, 95% of the contribution going to the retirement plan, which makes it very tax efficient. So that's a common misunderstanding that so much money has to go to employees. Like we just completed a case where the doctor was told by his CPA that, well, you don't want to put in one of those DB plans because, you got to give more than 50% of it to employees. And we finally got the tax returns and the census and all the other information on the employer. And we went back to him and said, hey, you don't have to give 50% of employees. You got to give 8%. You and your spouse who works for you, you're going to get 92% of the contribution. So that took away the stigma of having to fund employees.
Understood. So one of the things that a lot of people are unaware of is some of the more sophisticated strategies around planning around captive insurance agencies. You brought that up as a second solution. What is a captive insurance agency and how does it work and who's the ideal candidate for it?
Yeah, the ideal candidate are the type of companies that have some risks around their business that they either can't find insurance for, or the insurance that they do have, the property and casualty coverage they do have, excludes certain types of coverages or benefits. And so the basic structure is that the operating company will set up, the owner of the operating company will set up a C corporation, their own insurance company, designed to provide insurance for the operating company. And you hire an actuary to evaluate some of the risks you have. For example, we have one client who had material that was being manufactured in China, but if the ship sunk on the way from China to the United States, he couldn't find coverage for that, and they would have lost all of his product. That's just a very simple example. So we, through the captive insurance company, we set up that risk, and if that happened to him, then he could put money into that captive insurance company, take a tax deduction for it, and if that drastic event happened, then he can reimburse himself for the losses that he had. But the biggest selling idea for these captive insurance companies is primarily to, again, provide cover risks that you can't have coverage for from a traditional. Because as you may or may not know, when you buy property and casualty coverage from a major property and casualty insurance company, the way they price that out is about 50% for claims and 50% for profit of the insurance company. Well, you could do the same for yourself, where you're pricing the policy in your own captive insurance company that's providing coverage for you, so that you get rid of that profit cost that goes to the traditional insurance company and keep that for yourself. But the biggest factor is that as you make these contributions to a captive insurance company from the operating company to your captive, you get a tax deduction for that. Now, the captive company does not pay taxes on its premium. It only pays tax on the earnings on its reserves. And then ultimately, when you shut down the captive, at some point, you'll be able to take money back out of the captive and pay capital gains tax rates. So you've converted ordinary income to capital taxes to capital gains tax rates. Plus, there's some estate planning that you can get involved in with your pass this wealth on to the second generation. What is totally misunderstood by the public and the financial advisors is that as you create this money in IRAs and 401ks and defined benefit plans, everyone understands, and I call this unintended hubris by financial advisors. They don't know how to reposition funds and use the tax code to turn that money tax exempt or tax free. So if you have money in a 401k, DB, or an IRA, rather than sitting there thinking I've got to pay income tax on that as I draw it out, there's methodologies there that most advisors don't know about. In fact, our system's called a STAR system, STAR, which stands for Save Taxes Retire. So our STAR system turns all that pre-tax money in qualified plans. It could be in IRAs, 401ks, or DB plans. We turn that into tax exempt, tax free money. So we can convert that to tax-exempt income. So that's one of our best strategies that we've had for years now.
Absolutely. I think that there's definitely different ways that you can solve for potential future tax increases as well as the current ones that are coming down the pike. So, Peter, it sounds as if the most important thing to do is to start planning and continue to keep your eye on the plan over time.
That is correct. Which is exactly what you folks do at My Financial Coach. You do that planning process that is generally missing with a lot of clients.
Absolutely. We do that every day, but we rely on experts like you to give us guidance on what to do afterwards. And Pete, it sounds as if there is a lot that you can do if you are willing to do a little bit of planning to avoid some of the taxes coming down the pike, as well as do a little bit of hedging in terms of what current and future tax rates look like. I want to thank you for sharing an overview of at least two of these strategies. We thank you very much for hopping on the line, and have a very nice rest of your day.
You too, Enpo. Take care now.